everyone, my name is Maria Thomas and I work for Allianz Research, a global team of economists, strategists, sector advisors and foresight experts of the Allianz Group, led by Ludovic Subran. Over the past few months, we've seen central banks in advanced economies raise interest rates for the first time in years to cope with record-breaking inflation. So in this special season of Tomorrow, we wanted to look at the end of zeronomics. What will the new era of higher interest rates mean for the global economy and capital markets, households and companies? Let's find out with the experts from Allianz Research. Last week, the US Federal Reserve hiked interest rates by another 75 basis points, the latest in a series of moves to combat surging inflation. As a result, 2022 has brought an end to the long era of interest rates being at nearly zero or even negative in some advanced economies. In this episode, Allianz Chief Economist Ludovic Subran tells us more about the end of zeronomics and what is at stake for the global economy. Hello, Ludovic. Welcome to the podcast.
Hello, Maria.
So, low interest rates have been around for so long in advanced economies that for many of our listeners, they may not even remember a world without them. Can you tell us where zeronomics came from and how it's shaped the global economy over the past few decades?
You know, the idea of having nominal interest rates that are negative actually came up when the world was faced with the big fear of disinflation after the 2008 crisis, right? So central banks going a very unorthodox way with quantitative easing, but some central banks, like the European Central Bank, also decided to go into negative interest rates as a way to stimulate the economy, to stimulate lending. And I think this has been a life-sized experiment in a way that we are exiting now, with the central banks having to tighten very strongly in the face of inflation. And so that's why I coined it zeronomics, because I think this world of very low interest rates and in real terms. So basically, not the nominal rates, the one that you see when the central banks do their announcement, but when you correct it for inflation, real interest rates have been negative for quite some time, right? But this idea of going negative with the headline interest rate, if you will, was something that was rather debated and highly discussed in economic circle, whether it was good, whether it was not fueling asset price inflation, whether it was creating some form of new inequalities. So we are exiting this phase, and so it's time to take stock. And clearly the question is whether we will do that ever again, right? Or whether we learn that, we can do things without having to distort too much. This idea that money has no price, right? Which was really the idea behind this era of very low or even negative interest rates.
Well, that leads me very well to my next question, which is what's at stake now that interest rates are on the rise?
The world is in a very funny situation. Funny as in not funny, actually, which is we had the largest pandemic in the last 100 years. The world decided to do a great intervention with central banks doing the heavy lifting, but also fiscal policy being extremely accommodative. And we wanted to avoid insolvencies and unemployment and a protracted recession at any cost. And so we have now a bit the consequence of that, which is higher inflation and higher debt. It's especially true for the US, for the United States, where I think a big chunk of the inflation we see comes from overheating that is itself caused is coming from the extremely large fiscal stimulus that the US put into the economy. Actually, President Trump did the first real life example of helicopter money, right, by sending checks to every American during the pandemic. And so we have now this deceleration, this trifecta of lower growth, higher inflation, and now higher interest rate, which is quite new. Why? Because in Europe we have this energy crisis. This is really what is constraining growth at the moment and creating the vast majority of the inflation we see. But in the US we have this overheating, and so central banks, the Fed, and then as a consequence, every central bank on the planet is very determined to fight inflation with the interest rates lever. And so that means that, for example, in 2022, we expect that the Fed could go back as high as 4% for its key rate, and that the ECB could even go, closer to 2% for its key rate. Something that if you had asked any economists, even 9 months ago, when the war in Ukraine started, they really thought that the central bank so this idea that central bank will continue to do whatever it takes and will not use, their power to fight inflation and restore price stability by increasing interest rate. Many economists would have thought, no, they will have to help anyhow because it's a war, it's a negative supply shock, and why would they even start to increase interest rate if the world is going into recession? And they did. So there is two aspects to your question, which is central banks are doing what they're expected to do for credibility reasons, and also because we believe that hiking interest rates still works on calming down inflation. But there is also this idea that they've surprised a bit the world, investors, corporates, families, with the determination with which they decided to act very swiftly, going very high, and to a certain extent, also maybe risking even the so-called hard landing, right? So risking pushing the economy, especially in the US and certainly also in Europe to some extent, but also in many emerging markets, pushing the economy into a recession for the sake of fighting inflation. And which, if anybody was worried that central banks were not serious about fighting inflation, well, they're giving you the proof of the pudding right now.
And so is it actually going to work, do you think? That will they be able to cool down inflation in 2022?
That's the $1 billion question. I do think they will manage to have a substantial effect on calming the demand-driven inflation. So I do think that, 15% of the inflation in Europe, according to our estimates, is demand-driven, and more 40% of the inflation in the US is demand-driven. So I think, that means, almost half of the inflation can be tamed by the Fed going above and beyond. In Europe, the problem is that it is the smaller part that is related to demand, and so this is a bit, the jury is more out, I would say, on Europe. The big question here is, I think it will certainly help decrease the social tensions related to inflation. So that's really also in their mind. They want to prevent the wage price loop. So actually, when they're hiking interest rates, they're also sending a message to the unions, for example, in Europe. They also, I think it will work also because the transmission channels, like financial markets in the US, have reacted very strongly to the very hawkish central bank pivot. And actually in Europe, the banks, which is the main transmission channel of the monetary policy in Europe, have also started to reduce lending slightly. So I think they will succeed, right? But the cost benefit of this solution in calming down inflation, especially again in Europe, I'm like, I know, and I think chairman of the Fed Powell actually said that even for the US, it's not by hiking interest rate that you're going to decrease the price of gas at the pump, right? And it's particularly true in Europe, where we know it's a supply shock, right? Because Russia decided to retaliate by stopping any form of energy supplies while the sanctions are still on, the financial sanctions are still on in Russia. So what is interesting here is that I think central banks will they will calm down the overheating, but the risk is, of course, that they again don't manage it as precisely as they would like, and so that creates a bit of a stronger deceleration of growth, with a remainder of inflation that is still sizable. So in our forecast, for example, we have minus 1% growth for the US and Europe, give or take. And we still have, inflation above 3 or above even 3.5% in both areas of the world, right? So substantial inflation. And so that's a bit the issue here, is that the entire policy toolbox should be put to productive use, right? Trade policy, competition policy, also fiscal policy. And right now, central banks are really a bit the horsemen of trying to rein in inflation, when we know that, by reining in inflation through increasing interest rates, they are creating some negative spillover effects, like on very highly indebted countries in the emerging world, or highly indebted corporates in the US or Europe. This is a bit of an unfortunate moment, right? Because they already have some other issues at stake, like the energy bill, or, fighting COVID still, or adapting to a very rapidly fragmenting world, right? So this is why it's a bit of a difficult question. I salute the grit with which they are normalizing monetary policy. Again, the balance sheet matters also a lot. So how much, how fast will they reduce the amount of ownership of government bonds that central bank have? Because this is also the quantity of money, if you will, that central banks have been putting into the economy. So I salute the grit. I think they're doing the right thing. I'm still very uncomfortable about what, for example, financial markets are expecting, which is for them to do even more and even faster. Or I'm still very uncomfortable with so many observers that are berating and belittling central banks for having done historical mistakes. I think it's much more complex than this. And I think that if we really go into a recession, central banks will have to pause. And so the big question is, how will this pause be judged in the face of history, right? Because there will still be a bit of inflation, but you don't want to aggravate the growth deceleration that is indeed caused by many other factors, but just the inflation impact on the propensity of people to consume or to invest.
Thank you very much, Ludovic. That was very comprehensive. You addressed all of my follow-up questions.
I'm sorry, Maria. I like to talk.
It's your favorite topic, I'm sure.
Yes, why it's my favorite topic? Because I really think it's a new era. Some people used to coin Bernanke and stock, and a lot of people used to call the past 20 years the great moderation, because we didn't have so much volatility. Inflation was very much under control. Growth was meh, but we didn't have the swings that we have today, right? And I really believe there's been a regime switch here. There's been a first phase of the regime switch, which was the unprecedented action that central banks took to basically fight COVID, right? We paused the world for many months, and to a certain extent, we managed to avoid a form of major shock to the economy, right? But we have some scarring effects, and on top of that, you have a war and an energy crisis that is really, again, the worst case scenario for central banks, because you have an exogenous shock that is causing a big acceleration of prices, and you have just pumped into the economy so much that you hoped that there wouldn't have been so much inflation, right? And you add to this the labor shortages and the supply chain, disruptions. And it's true, it's a bit the perfect storm, right? And central banks are rising to the occasion to remind everybody of, how serious they are in doing what they are supposed to do, but in a world that has changed dramatically, and in a world where, the Faustian pact between fiscal and monetary policy is unclear, right? Will fiscal policy take over the baton from monetary policy? I'm not sure. It's very costly to help soothe the purchasing power impact of an energy crisis. Will the fast normalization of central banks be without causing bankruptcies or without causing liquidity issues in the financial market? I'm not sure. And to be fair, I'm concerned about this very rapid change of heart, right? The pace, of the tightening cycle is quite strong. And that's why a lot of people go back as far as the early 80s to understand that the last guy who did that was Volcker, and he created a hard landing in the US, right? Very strong recession. So people are going back in time trying to compare, but we live in a much more interdependent world. The reason behind the inflation are clearly about the energy crisis, but there is a war at stake. There is also a mending economy from COVID and the many disruptions that have been, I would say, absorbed without really making sure we understand them. And so I think it's missing the elephant in the room, which is the role that central banks, that the financial cycle is playing in the current environment is really bad, right? So I encourage every every company, every CEO, every policymakers to really again take a look at the role that interest rates play in different aspects of the business or on the country management, because we've been used to working in real terms because there was not so much inflation. So, people didn't look at the difference between nominal terms and real terms. And with inflation, everything is different. If you, the Minister of Health, if you, the CEO of a transport company, you can see the nominal world very bluntly, in your decision meetings. And so, whatever is happening on the central bank's world, whatever is happening on the cost of money, is also changing completely, your investment function is also changing completely the type of arbitrages you do. And so rediscovering that part of the economy that has been clearly put on the back burner for the past 20 years because there were other great things happening and certainly things that were having a bigger role in explaining a lot of things like the rise of China or the rapid financial globalization or, the digital dividend and so on. And now we go back to basics and people still, I would encourage everybody to reopen the textbook on monetary policy because it is creating, this is explaining a lot of what they see, what they experience in the daily life of business or running a country.
Mm. Well, maybe to end, can we talk about what you think the missing piece of the puzzle is? Because you've alluded to it a little bit, the fiscal policy, the trade policy. Could you explain for our listeners what else needs to go alongside this tightening of monetary policy to bring down inflation?
Again, I mean, there is this assumption, especially the ECB, Isabel Schnabel in Jackson Hole, she basically said, whatever the source of inflation, we still have to hike interest rates because we're working on expectations, right? Anticipation. So we need to anchor inflation expectations in the future. And so as a result, whatever the source of inflation, we have just to hike so that, wages don't increase too much and create a feedback loop into prices, and we don't have all of the difficulties of having an anchored inflation expectation, especially on the credibility of the central bank and how uncomfortable this situation would be in terms of how high and how swift they would have to do even more, creating for sure a recession, right? So, and I would disagree with this. I think it's a very nice explanation of the rationale behind the ECB trying to keep up with the Jonases, meaning the Fed, right? But to if you look at the US, if you just go back to pre-Trump trade barriers, so if you go back to import tariffs and if you favor the consumer over the producer, you would shave off at least 100 basis points of inflation in the US, 1 point, not 1.5 point. In Europe, if we just would stop thinking that the energy market is a functioning market and spend 250 billion in 6 months to fix a market that is failing us by design, and we would just have fixed or partially capped energy prices, we would have maybe 2 points of inflation less, right? In the US, 55% of all meat consumed is coming from 4 companies. That's called a cartel. That's not a market. So you have to work your competition policy muscles so that you make sure that you are talking about real inflation as measured by a price setting mechanism between supply and demand, right? And so forth and so on, right? On fiscal policy, there are a lot of talks right now about some of the support measures to fight off the energy crisis, creating more inflation. We need to debunk some of this myth. I don't think that the poor people to whom you're giving energy checks that can help them heat their home and put fuel in their car so that they can go to work, I don't think this is what is creating inflation, right? What is creating inflation may have been the bubbles that you have created on the property market, for example. So that means you need macroprudential policies, you need better housing policies. You see my point? It's just like, once again, people are just putting too much on the plate of central bankers. And I'm sorry, there are unelected powers and there are elected people that still have a lot to do to calm down inflation. And I think it's fair, and the central bank has to do a lot because they are somehow in charge of this and they also are co-responsible for part of it. But I do think that not seeing the full picture and what the entire policy toolbox is to fight off inflation is not smart, right? And just I give you another example: labeling, and consumer protection in terms of inflation is extremely important. Housing and rents, right? Or, utilities or education and health expenditure, which are super regulated markets. You have to think holistically if you really think that inflation is creating a social risk in your country. And I think we're just waiting for, and praying that central bank action will work. I'm not sure it will do all of what we need to do. And more importantly, it is the lazy solution when you see some of the sources of inflation being related to mistakes that we've made in the past and we haven't resolved yet.
All right. Well, thank you very much, Ludovic. This was very informative.
Thank you so much, Maria, for the time, and see you soon.
Thank you so much for listening. You can find the full report we just spoke about on our website. We'll leave a link in the show notes. If you'd like to discover more of our research, you can also follow the Ludonomics newsletter on LinkedIn. We'll leave a link down below for that too. If you like the podcast, please send it to any of your friends who might like it too, and leave us a rating and a review. We'd love to hear your feedback. In the meantime, stay tuned for the next episode.